Let me ask you something. Pull out your phone right now. There's probably an app on there, maybe Robinhood, maybe Cash App, maybe Fidelity, where you can take $20, tap a button, and own a piece of Apple or Amazon or Tesla. 20 bucks, one tap, done. Now, here's the part that blew my mind when I first learned this. 50 years ago, that was not just hard, it was impossible for most people. Not because the stock market did not exist, it did. Not because people did not want to build wealth, they did. But because the entire system, the rules, the fees, the gatekeepers, was quietly designed to keep regular people out. And today we're going to go back in time and I'm going to show you exactly how that worked. So let us start right now, today. You want to invest. What do? You download an app, you link your bank account, you pick a stock, maybe a company you actually use like Starbucks or Netflix, and you buy a fraction of a share for literally $5. No appointment, no suit and tie, no minimum balance of $10,000, just you, your phone, and a few minutes. And that is kind of wild when you think about it, because today, a 19-year-old working a part-time job at Target and a 50-year-old hedge fund manager in Manhattan are technically using the same market, same stocks, same opportunities. But here's the interesting part. That is new. Like really new. For most of modern American history, the stock market was not for regular people. It was for a specific kind of person, a wealthy person, and the system made sure of that. So let us go back, way back, and I'll show you what investing actually looked like before any of this existed. The stock market has been around in America since the late 1700s. The New York Stock Exchange was formally founded in 1792. That's older than most countries. But for most of that history, the average American had absolutely nothing to do with it. And it's not because people were lazy or didn't care about money. It's because getting into the market required one very specific thing: a stockbroker. Think of a stockbroker like a gatekeeper, a middleman. You couldn't just walk up to the stock exchange and buy shares yourself. You had to go through a licensed broker, someone who was authorized to make trades on your behalf. And that changed everything. Here's how it worked. You would call up a brokerage firm or physically walk into their office, dressed nicely, and you would tell them you want to buy some shares of, let us say, General Motors. The broker would look you up and down, check your account balance, and if you had enough money, maybe they would help you. If not, goodbye, because brokers in those days had minimum investment requirements. We're talking thousands of dollars just to open an account. In the 1960s, that might be $5,000. Adjust that for inflation, and you're looking at roughly $50,000 in today's money, just to start. And this is where things get frustrating. Even if you had the minimum, you were not done paying. Every single trade, every time you bought or sold a stock, you paid a commission to your broker. And we're not talking a small fee. Before 1975, commissions were fixed, meaning every broker charged the same rate, and the government regulated it. There was no shopping around for a better deal. The typical commission was around 1 to 2% of your total trade. So if you bought $1,000 worth of stock, which was already a lot of money, you would pay $15, $20, sometimes $30 in fees just to make that one trade. And then you would pay again when you sold. For a working-class family making maybe $10,000 or $15,000 a year, that math just did not work. But here is another layer that most people do not talk about. It was not just the cost, it was the information. Today, you can open any app and see live stock prices, analyst ratings, company earnings reports, and global news all in real time for free. Back then, none of that existed. Stock prices were printed in newspapers the next morning. So by the time a regular person saw that a stock had moved, it was already old news. The wealthy had something called a ticker tape machine, a physical device in their office or club that printed stock prices on a little strip of paper in real time. That machine was not cheap. It was not something you would find in a regular home. So the rich knew what was happening in the market as it happened. Everyone else was guessing. And think about what that means. If you do not know what prices are doing, and you're paying massive commissions every time you trade, and you need thousands just to start, you're not really investing. You're just gambling at a disadvantage. Here's a simple way to picture it. Imagine the stock market is an exclusive country club. To get in, you need to pay a massive membership fee. Then you need to be invited by a member, in this case, a broker. Then, every time you use any of the facilities, you pay extra. And all the best information about what is happening inside the club only gets shared among the members who have been there the longest. That was investing before apps. It was not just about money, it was about access, and access was carefully controlled. Now, think about this for a second. From roughly the 1950s to the 1990s, 4 decades, the U.S. economy boomed. Companies like IBM, Coca-Cola, McDonald's, and Ford were growing like crazy. The stock market went up hundreds of percent over that period. Massive, life-changing wealth was being created, and almost all of it went to people who were already wealthy. Not because they were smarter, not because they worked harder, but because they had a broker, they had access, they had the minimum balance, they had the information. Meanwhile, a factory worker in Ohio or a nurse in Georgia, someone putting in long hours and doing everything right, had no way to participate in that growth. Their savings sat in a bank account, earning maybe 3 or 4% interest, and the gap between the rich and everyone else just kept growing. That's not a political statement, that's just math. When one group gets to grow their money at 15 or 20% a year through the stock market, and another group gets 3% in a savings account, after a few decades, the difference is staggering. And most people had no idea it was even happening because nobody talked about it. Investing was not a dinner table conversation for regular families. It was not taught in schools. It was just this thing that happened somewhere else, in some office in Manhattan, among people.